In the last class, we have completed the pricing of material issues, and also I asked you to try some additional illustrations by giving the small idea about. In this, if you receive and issue, those things are placed here in chronological order: first, 20th, 22nd. Is that okay? See here in this illustration. First September, balance and goods received on 4th September, then 6th September, 7th September issue and return and issue. All the received as well as the issues are ordered based on the date order. This is called perpetual. Perpetual means whenever the goods received, immediately recorded. Whenever the goods are issued, immediately it is subtracted from the balance available. That's called perpetual. But in practical life, you don't do the perpetual way of stores ledger preparation, because the accountant may have a number of different jobs. He will collect all the details only by the end of month. He will close all these things. Then it is called periodical stores ledger control account or periodical preparation. How this account will be? Question number 5. From the information given above, work out the following using FIFO and LIFO of inventory valuation, assuming pricing issue being done at the end of the month. At the end of the month. Is that okay? Let's see. In this case, how will I work out? I am going to follow FIFO method. Now, sales, opening stock and purchases, these are receipts, opening stock plus receipts. And what about the issues? What about the issues? Opening stock plus purchases minus closing stock is nothing but issues or consumption. Opening stock being 1,25,000, purchases being 2.5 lakhs, 3.75 lakhs, and we have closing stock being 1.3, 2.45 lakhs may be the issue. Is that clear? Now, using the FIFO method, let's see. On 1/3/2002, opening stock we have how much? Receipts, issue and balance. 1,25,000 liters at rupees 30 each. Then I'll put the value in thousands. 125 liters, 30 rupees, 3,750 rupees in thousands. Again, you have to add all the purchases in that period. Up to the year end, first add the purchases. Never bother about the issues now. You go to adjust the issues only at the last day. So here purchases 5th March, purchases 150,000 liters at rupees 31.1, issues being purchases being 4,000. Okay, so in the end we have 125 liters at rupees 30, another 150 units at rupees 31.1. Again we have one more purchases on 27th. 27th March 2002, purchases 100,000 liters at rupees 31.2. The overall amount we spent here being how much? 3,120. You can score out that issues also can be recorded later on in this model. So 125 units at rupees 30, 3,750. 150 units at rupees 31.1, value being 4,665. Another 100 units is there, the value being 31.2, 3,120. Now we have the issues. As I am going to follow which method? FIFO method. I am going to follow FIFO method. In case of FIFO method, issue will be priced how? 245,000 liters were issued. As we follow the FIFO method, 125 units will be first taken at rupees 30. And balance we still have 120 can be from the next pricing 31.1. What's the value? 3,732. Now what is the balance you have? 130 units at rupees 31.1. Another 100 units at rupees 31.2. This value being 933 thousands. This value being 3,120. So issues being 245. This will be the issue. Okay. What about the profit? Sales being 79 lakhs 10,000 minus general administration overhead and cost of goods sold. So we will now subtract the material cost of sales. Cost of sales being this one. Under FIFO method, you have to subtract this one. Yes, come on, tell me the value. Cost of sales. In thousands, cost of sales. You add up these two, I think this value being 7,482. And we still have the administration expenses, 172. Add up these two, the total cost being 7,654, and your gross profit being the difference between this, simply a profit. Profit in this case being 256. So what are the things are asked? Closing stock value, cost of sales value, profit and loss. So this will be the closing stock value. units, 130 units we have, total value being, you add up these two, 4,053, and your profit is also found out. Profit is also found out. So closing stock value, cost of sales value, profit value we got under FIFO method. What happens, sir, if I follow LIFO method? In LIFO method issue, from the last value you have to start issue. It's the last value of the month, probably 27/3. Before that, on 25th March 2023, March maybe issue. Even though the issue happens before this purchase as per the periodical one, the moment you prepare, by the time you add up all the receipts, in that the latest rate will be taken under FIFO method. Is that clear? Because we are not going to arrange the FIFO and LIFO now and then whenever it happens. That's called perpetual. Continuity will be there, but here continuity will not be there. It's a breaking. Month on month it will be prepared, or once in every month it will be worked out. Otherwise it will be having a break for the month. Now 100 units, 31.2, 3,120. 245 issued. No, another 150 from here at rupees 31.1, 4665. And 245, right? Okay, sorry. Then it here is 145, the value being 31.1, 4,000. $509.5. Now, if you subtract what is the balance you have, the first item remains as it is. 125 units at rupees 30, 3,750 remains as it is. In this 150, only 5 units are there at the rate of rupees 31.1, 155.5. Now the total closing stock value for 130 units being 3,905.5 under this method. Similarly, under the FIFO method, sales will be the same, 7910. Now find out the cost of sales. The issue will be the cost of sales. The cost of sales in this case being 7,629.5. Admin overhead remains the same, 172, and total cost being 7801.5, and your profit ultimately you will be getting here being 108.5. Clear? Hope now you'll be able to understand FIFO as well as LIFO. This one is LIFO method. If it is clear, text me. We'll move on to the next one. Next question. Now, in labor costing, what are the things you have to study? Okay, sorry, material costing. In material costing, okay, we have 4 blocks to be studied. One is ordering quantity, another one is levels to be maintained. Levels to be maintained. Third one is all about pricing and some related ideas like some theory. theory with some assumed illustrations. Selection of supplier. Okay. And ABC analysis, VED analysis and all. And understanding the spoilage, defective, scrap, waste, etc. And better you need to know the some turnover also. These are some basic illustrations with conceptual requirement is there for understanding the material cost. We have studied the EOQ already. We have completed the levels, minimum level, maximum level, VR level and all. In pricing, we have FIFO method, LIFO method, and where we have continuous stock taking method as well as periodical stock taking. So earlier we have seen that pricing, that is called continuous stock taking method. Instead of that, if we go for calculating the FIFO or LIFO once in every period, once in every 3 months or once in every month, then it's called periodical pricing method. Now the main intention of material cost, studying this material cost, is to reduce the unwanted investment in stock that leads to ultimate reductions of cost you spend for the material. By understanding the EOQ, you can find out the exact size to make the cost for ordering will be lesser. Fixation of raw material levels also studied. Pricing of material issues. So these are the three predominantly calculation based illustrations. Apart from that, one more thing, cost determination. Fourth one, how can we determine the cost of raw material? Raw material, what's the cost of raw material? Actually, you might have studied in your financial accounts. Okay, if I purchase a raw material or material for rupees 1000, for that we spend around 50 rupees for the carriage in, and we paid commission for purchase around 25 rupees. Now tell me, what is the cost for the raw material? It is not 1000, it is 1000 plus 50 plus 25. The cost you spend to bring the material and store to your place will be included in the cost of the material itself. Similarly, in case of finished goods, in case of work in progress, how can we calculate all? So this will fall under this case. Cost of raw material, work in progress and finished goods. And classification of the inventory. Classification of inventory predominantly, we may follow one of these 5 aspects or methods: ABC, HML, VED, FSN, FSND. A category material, B category material, C category material. A category material may be limited quantity but value is very high, like gold in your home will be kept in the locker, right? And furniture may be kept outside simply, and any garments will be kept in the bureau. So nature of the importance of the material, you will handle it properly, right? So same happens. What happens? You may have surplus dresses, right? Do you have surplus dresses or not? How many of you have surplus dresses? Sir, plenty, sir. How many of you have surplus chains, bangles, rings, jewels, bracelets? How many surplus you have? Sir, not even single, sir. Why do I bother about the surplus then? Understand? So it's a costlier. Keeping one surplus will be extremely costlier. The holding cost is very high. The same happens in case of A category. It will be very expensive to have the surplus. That safety stock, we never bother about to have safety stock for the gold. Similarly, A category. We may have the safety stock for B category, right? Dresses, okay. And the last one, we never bother about the means control at all for C category. Value is lesser and plenty of quantities are available. Such a way we classify the material and then we'll implement our stringent control over the material. So one is ABC analysis. Okay, always better control, like you can expand this. A category material, B category material, C category. High, medium and low value goods, another analysis. Vital, essential, desirable, another one. Fast moving and slow moving, non-moving, or this one fast moving and slow moving and FNSD, FNSD. Fast moving, normal moving, slow moving, dead stock, not at all moving. Such a way we can classify. So we will not lock our money in dead stock or slow moving. We always care about the fast moving goods, because you need to have plenty of stock and safety stock for fast moving goods, otherwise you will be running out of stock. And while processing the stock, what you have may be lost. That loss may be waste, scrap, defective, and spoilage. How can we handle, and what are the differences among these terms also going to be studied here? Theoretical and small illustrations. And inventory turnover, usage, or using it properly or not, is studied under inventory turnover. We'll see that here. And your stock may be sometimes lost. The loss may be due to the normal course of action. Sometimes it may be abnormal reason. So in case of normal, how can we handle? In case of abnormal, how can we handle? So all these aspects are going to be covered in material costing. Predominant calculations parts are over with this. Rest of the things are small illustrations. So EOQ we have completed. And ordering cost, carrying cost. What are fall under ordering cost and carrying cost also we discussed. Some assumptions and all. Inventory, stock control system. We have perpetual inventory system. Perpetual inventory system. What is called perpetual inventory system? Whenever stock comes in, immediately you add and record properly. When the stock is issued, immediately subtract from your stocks available. So you will be able to find out what is the stock you have in godown absolutely. Right. Accounts department prepares the stores ledger now and then whenever it's happening. So whenever we ask about the stores available with the accounts department, he will say, I will have 1 lakh units. If you go and check the storeroom, it will have 1 lakh units. That is called perpetual. In case of periodical, he prepares once in every 3 months. By the time only he knows what is the stock he has. Until the time he doesn't know. Okay. He roughly calculates, not physical verifications done there. So in case of perpetual inventory system, stock control system, a continuous record of receipts and issue of material is maintained. Continuous. Okay. Bin cards and then the store ledger show clearly the receipts and issues and balances, because once the goods comes, storekeeper also records and the accounts department also prepares in the store's ledger account. So immediately matches, both are same. This system facilitates planning of uninterrupted production. So as he is always cross verifies what's the stock available in godown and from his records. From his records also he can finalize what's the stock available. So he can simply decide if there is a stock out, he can plan ahead. He can plan ahead. In case of continuous stock taking, okay, physical verification of stores on continuous basis is taken. Any discrepancies is noted and appropriate rectification is taken immediately. This will be the advantage of perpetual inventory system, where continuous stock taking is a tool for perpetual inventory system. Once you record in your bin card, immediately go and check whether that stock is available in the godown also. Both are matching, then there will not be any discrepancies. If there is any discrepancies, immediately is adjusted. A perpetual inventory system is usually supported by a continuous stock taking system. So this one is possible only because of this one. Okay. So you can attain this facilities, perpetual inventory system, with the support of continuous stock taking. Now, purchase requisition. Already explained about the theory. Is that okay? How the bin card and other things are working here. Let's see. Purchase requisition is prepared by whom? Storekeeper. Purchase order is prepared by purchase department in charge. You understand? So purchase requisition is raised by the storekeeper the moment the stock available in the godown touches to the reorder level, intimates to the purchase department to procure. Thereafter, it's the purchase department's duty to place the order after finalizing the different quotation you receive. So purchase requisition for stock, date, requisition number, date of requirement, all these things will be there and signed by storekeeper. In this case, purchase order is placed. Okay, ABC Limited places this representing to with reference to your quotation number, dated this much of quantity needed, everything is placed and signed by purchase officer. You have to understand the difference. Okay. You have to understand the difference between bin card and stores control cards. Bin card is prepared by storekeeper. It is used to record receipts, issues, balances of quantity only. But in case of stores control card, similar to bin card, but contains stock and order also. Stock and order also. Okay. Stock control card. See, once you order, the goods gets delivered after a week's period, right? In bin card, you have three: receipts, issues, balance. You have 100 units in the beginning, purchased another 50, then you have 150 units, 20 units issued, then it will have 130 like. Is that clear? But in case of stores control card, receipts, issues, order placed awaiting for receipt. When initially there is a 100 units balance, another 50 receipts, then 150, another issued 20 is there, so 130. By the meantime, 100 units ordered fresh, supposed to be received. This additional column will be there for stock control cards. Clear? Now you have to understand two bin system. So two bin system is nothing but the two bin you have in your home for a gas cylinder. You have two cylinders. Okay, cooking cylinders. Why do you have LPG cylinders, two cylinders? To warn you to replace the one more cylinder once the first cylinder gets empty. In bike and car, there's a reserve point. The moment it touches to the reserve point, there will be warning sign. Immediately you have to go for filling the petrol, otherwise you will be running out of the stock. Similarly, you have two stores, predominantly maybe same size or a smaller size and bigger size. You start consuming the stocks from this. The moment this one is over, before you start consuming from here, you place the order. So this will be the stock available here will be equal to the reorder level. Hope you will be now able to understand two bin system. The bin has two parts. One part should stock the reordering level, this one, and the other to keep the remaining quantity. Issues are made out of the larger point. So we usually issue from this part. But as soon as it becomes necessary to use the quantity out of the smaller part, once it is over, once we start use from here, then it's your time to order fresh. Order fresh. Now, you have to understand the difference between stores ledger and bin card. Here it's a stock control card. This is stores ledger prepared by the accounts department. So maintain in the stores costing department. Purpose: stock registered, how many units they have, what's the fresh purchases, what's the fresh issues they have made will be recorded here. It's an accounting record. Posted by storekeeper, by ledger clerk or accountant, and records only quantity, here quantity and value. Posted at the time of issue of material, here after the issue of material. The moment the goods goes out, immediately being caught, the storekeeper records. After recording only the goods will move out. But unless he intimates the accounts department may not know, so he has to send this document to the accounts department for further recording by him. So it will take after that. Clear? Now, how should be a bin card? Already explained. Bin card usually contains with what? Maximum quantity, minimum quantity, reorder level, and reorder quantity, everything. What material and all. And you have receipts, issues, balance only quantity wise. Okay. Instead of sometimes you may have stores ledger. So we have seen already bin card as well as stores ledger in the example itself. So you don't need to worry about that. Now, you have to understand the term bill of material here. Bill of material. So what is called bill of material? Bill of material is prepared by whom? Prepared by whom? Production planning department. The moment production planning department gets the order and directs the production department to manufacture, a bill of material is also prepared. Okay, if supposed to produce 1,000 tables, that's how I discussed in the previous classes. If you're supposed to produce 1,000 tables, okay, what could be the material requirement, steel requirement and paint requirement? Even if you are using small portion of plastics and wood, then how much of that is required? Everything will be posted in the BOM an estimation for producing that and allowing the production department head to procure those things from the stores. This is called bill of material. So, bill of material is a list of materials required for a particular work or job order prepared by the production planning department, handed over to the production department in charge. Now he has the rights to procure the required raw material as well as this BOM. So, pro forma of the bill of material, usually you will have four copies. Four copies. One is for stores department, another one is costing department, another one is production control department, finally production department. It will be sent to four departments. How the bill of material could be? Job number 101, whatever it may be, just give the number. Department authorized to procure date, steel requirement, plastic requirement, wood requirement, everything will be posted here, and quantity and issue, whatever it may be, everything is placed here. While released, this goods storekeeper will sign. This BOM is already prepared by the production planning department. Okay. Now, what is called MTN? Goods are issued from the stores department. Assume this is stores department, production department. Production department has two jobs, A and B. Production department requests goods, say 100 units, stating that I need 100 units to be used for job A. But production department is parallelly doing the job A as well as B. After it gets delivered in the production department, later on, production department realized out of 100, 40 units not required is transferred from A to B. The units used for asked for A but used for B. So then, while preparing the costing department, here this cost may be included for the cost sheet of A, no. So there you have to subtract and add to the B. Add to the B. For that, information is sent to the accounts department. That information will be available in the MTN. Surplus material arising on a job or transfer from one department to the another within the same organization, then MTN is raised within the same organization. Okay. It is made in duplicate, is sent to the cost department and transport department where it will not available. Stores department, it will not be. Already told, while preparing for the goods transferred within the production department from one job to next job, it will not be posted in the stores. They are not required. Okay. That will be finally adjusted while preparing the job cost. So costing. So subsequent lectures will be discussing about the job cost and batch cost. In that job cost, I just mentioned the same concept here. Goods transferred note. Okay. GRN, goods received note, and this is material transfer note. No entries made in stores record. Now, classifications of material. How do we classify? ABC analysis. Always better control. HML, high price, medium price, low cost item. VD, vital, essential, desirable. This VD analysis predominantly used in case of spare parts inventory, vital spare parts, essential spare parts, and desirable spare parts. If the vital spare parts is running short, definitely our entire business gets collapsed. So we need to maintain really a safety stock also for the vital item. And FSN, fast moving, slow moving, and non-moving. And FNSD analysis, fast moving, normal moving, and slow moving, and dead stock. Fast moving, the goods purchased immediately, it could have been sold or used for manufacturing. That's called fast moving. If it is not moving at all, then it's called dead stock. Hope you'll be now able to understand this one. So these are the small theoretical background you need to have clear. Now, let's see ABC analysis. Pareto principle, ABC analysis, referred or recommended or propounded by Pareto. It's a famous theory. Actually, Pareto says always 80-20 rule. 80-20 rule. Huh? You might have heard about, right? Very often. Rich becomes richer, poor becomes poorer, right? Otherwise, 80% population are having only 3% nation's wealth. 3% people will be having 80% nation's wealth, right? That is also a variation of ABC. So in ABC, value 70 percentage, 20 percentage, 10 percentage, but quantity only 10 percentage, 20 percentage, 70 percentage. Okay, 10% are holding 70% wealth in India. 70% are holding only 10% of the wealth of entire world. But merely in absolute sense, value being 97, this is 3% naturally. Go and cross verify. This is a famous principle applicable for all the places. Okay, what happens in your case? Huh? A, B, C preparation topics. You may prepare almost 70 hours for A, but you get only 10 marks. We'll put here 70 hours you work for 10 marks. 20 hours you'll work, surprisingly you'll get 20 marks. Sometimes you'll work only 10 hours, but you'll get 70 mark. Just before the examination, your friend tells you, just remember this, you'll get mark. Naturally, you'll get the same question also in your examination. You can score 20 or 25 marks in that. Oh my God, such a thing happens in the earlier men, we could have been sent up. But it will not happen. So finding which 10 hours will give 70 hours requires so much of dedication. Okay, the same always happens. The same always happens. This is called Pareto principle. Okay. There's a motivational stories also and books also available on this topic, 80-20 rule by Pareto. Okay. You can go and listen some audiobook available for the Pareto principle, right, in YouTube. Okay. I think it's still available. Pareto. This will be called in a famous manner like 80-20 rule. See, the moment I put 80, immediately comes Pareto. 80-20 rules. Ah, 80-20 rules. Pareto principles. Do more by doing less. 80-20. Then it's an animated version. So one of the famous theory. 80-20, 80-20. Okay. So many 80-20. So most probably in your schools also, 3% students scoring around 70% of the marks. Right. So the same happens. So one of the fantastic case. See, when it's all about material, value is higher, quantity, your number of quantity you have is lesser, is the A category, like gold. Inventory control is required more stringent way for this one. And in case of this one, like a normal furniture and vessels and all kept in the open house, this will be in bureau and cupboards like dresses and other things, costly dresses and all. Always happens. C, value. A class items will have high value, B class item will have moderate, C class item will have low value. And control, for among the three, where you need to put more control. A. Safety stock, I don't have the safety stock for A. That's why I asked about this one. How many of you hold 2 or 3 jewels for the safety stock, sir? If I lose or forget this chain, I will immediately replace new one, sir. If I lose, somebody steal my chain, no problem, sir. I have the safety one more. Do you have that? But dress, during the accident, your dress may be torn. So it may be torn. So immediately you can replace. You have the safety stock, but not for the gold. If you have that, no problem. I'm here. Donate me also, right? So safety stock, you don't have safety stock for A time. And follow, you need to have more follow for BA. Value analysis, you have to verify whether it is really important for purchasing or not. If it is a small item, you never bother about analyzing to purchase. Immediately you spend the money to purchase. How long you spend for purchasing the day-to-day accessories like fast-moving consumer goods, soap, whatever it may be, powder and all, go and carry. If the soap after purchasing, releasing is not fit for your skin, you throw it off. But when you plan to go for a diamond necklace, you purchase, if you don't want, then you can throw it off. Will it be happening? So you'll put lots of efforts, rigorous analysis before you purchase, value analysis, before you use it. Handled by senior officers. And this will be anybody. Okay. Yes. See this illustration. Classification of material. Actually, this ABC, predominantly theory. Rarely, sometimes question may come. So this one of the questions I have seen in the previous exam. So I incorporated this. Okay. Also given in CMA material, CA material. ABC analysis. What do you understand by ABC analysis of inventory control? A factory uses 4,000 varieties of inventory. In terms of inventory holding and inventory usage, the following information is compiled. So 4,000 inventory. Out of that, number of varieties of inventory, 3,875, 110, 15. But the value may be 100 rupees. All these 4,000 units are valued at rupees 100. In that, this 3,875 units, almost 97% of your entire commodity. Costing only 20 rupees. Costing only 20 rupees. Usage is also very, very less, meager usage. Okay. Quantity is higher. Value is decently higher. Very lower. And usage is also the least. Then it will be named as C. This is the question in your examination. This is the answer. Before you write this answer, write the theory I have discussed earlier. In case of 110 units, almost closer to 3% of your commodity. Value is almost 30%. Usage is almost 10%. B category. And this one is just merely 0.375% only. But value is 50% of all the commodities value put together. And inventory usage, high usage, then this will be A category. A category requires more stringent inventory control. Clear? Hope now you'll be able to understand this one. Next one is all about inventory turnover ratio. Inventory turnover ratio. So for inventory turnover ratio or stock turnover ratio, okay, the formula is sales or turnover by average inventory. If average inventory is not available, then you can take the closing inventory. Here we have been given sales or cost of goods sold or purchases. Opening stock 90,000, purchases 2,70,000, 3,60,000, minus closing stock 110, 2,50,000 rupees will be the cost of goods sold or consumption. With that GP you have to add. If you are aware about the cost, you can take the cost in the numerator 2,50,000. Average inventory being the opening plus closing by 2, 1 lakh. Then as per the inventory turnover ratio, you get 2.5 times in a year. 2.5 times in a year. Otherwise, you can calculate inventory turnover ratio in days. Inventory turnover ratio in days, or simply stock velocity. Stock velocity. Okay. The formula in this case being days or months. It may be days or month also. Divided by inventory turnover ratio, ITR. So year has 360 days, like you can take either 365 or 360. 360 has more factors, it's better to take 360 here, no problem. Or it's your choice. In text I use 365, I use the same, divided by 2.5. 146 days. What does it mean? The stock what I have purchased will be with me for 146 days. From this it is very clear, if the inventory turnover ratio is high, inventory turnover ratio in days will be low. Am I right? So denominator value is increasing, then this value will be lesser. Instead of 25, if it is being 2.5, 25 times means you divide by the 25, then this time period being 14.6 days or 50 days. If the ITR is high, the ITR in days is low, and if it is low, then it is high and mid-range. See, inventory turnover ratio in days or months is nothing but number of days that the inventory we purchased and kept in our godown before consumption. Number of days holding. Days holding. If the number of days holding is high, more days, then this will be called as slow moving. This will be called as fast moving. This is called as normal moving. Fast moving, normal moving, and slow moving. That's how you can link the inventory turnover ratio with the classifications of material. If you might have studied the FM paper, no, there you might have studied all these things in detail. Financial management, especially ratio analysis chapter, and this one inventory turnover ratio, along with working capital management. So there you studied, right? But here very rarely asked, only one point is given to decide. How can we decide, sir? It's fast moving. So fast moving can be decided based on the higher inventory turnover ratio or lowest inventory turnover ratio in days. Clear? Shall I move on to the next one? Now, so we have completed ABC analysis and inventory turnover ratio. Pricing also over. We have to study this wastage and spoilage later on. Now we have to try to understand how can we determine the value of material received or manufactured, or it may be in the form of semi-processed one. Is that okay? This one you can easily solve this with a little bit of attention. Let's try to solve this now. Yeah, come on, join with me to solve this illustration. Calculation of raw material cost and finished goods cost. A manufacturer of Ahmedabad purchased 3 chemicals X, Y, Z from Mumbai. So these are the 3 chemicals. Invoice gave the following information. A shortage of 200 kgs of chemical X, 280. These are the shortage. These are the shortage. Okay. Here 280, here 100 kg. Was noticed due to breakage at Ahmedabad. The manufacturer paid octroi duty at the rate of 0.1 per kg octroi. He also paid cottage 22 for chemical X cottage 22 and 63.12 for chemical Y and 31.8 for chemical Z. And octroi being 10 paise on the goods delivered. Calculate stock rate that you suggest for pricing the issue of chemical, assuming a provision of 5% towards further deterioration. Apart from that, another 5% we may lose. 5% stock loss will be there while storing that in the godown. This shortage happens before it gets delivered at Ahmedabad. Is that clear? Now you have to find out what is the price per unit of X, Y, Z. You have studied that pricing, right? FIFO and LIFO. In case of any receipts, 100 units received for rupees 1, 100 into 100 rupees. That's how we can easily solve in case of pricing of material issue. But here, how do you calculate that rupee 1? Isn't it? That 1 rupee is not the rupee you pay for the material. You have to bring that material to your godown, right? So for bringing that to your godown, any expenses you spend, no, that is also forming part of the price. That's how here I am going to calculate the value of X, Y and Z. Let's try to solve this one now. Yes, tell me. Let's start with the price. Okay. X, Y, Z. Okay. Purchases in quantity. How many quantities purchased? 3,000, 5,000, 2,000. While it is delivered at Ahmedabad, shortage happened. 200 for X, 280 for Y, 100 for Z. This is what about the quantity delivered. 2,800, 2,720, sorry, 4,720, 1,900, 1,900. And during the storage, we further lose how much? 5%. So minus deterioration loss, okay, 5%. On this 5% means 140 may be lost, 236 may be lost, 95 may be lost. Finally, quality quantity available for the real supply being 2660, 4484, 1805. 1805. Hope now you'll be able to understand this one. Now, quantity we found out after subtracting the shortage. We now found out the number of units we can use it for the production purpose. Come on, tell me, whatever the cost you spend, will you be going to calculate cost per unit based on the 3000 or based on 2660? If the milk, if you are ordering coffee in a restaurant, okay, so the bill comes like this: milk 150 ml, 15 rupees, and coffee powder, other thing. Immediately you just go and verify, and finding that the milk available, the coffee is only 120 ml. Will you fight there? Immediately the restaurant will tell you, due to the evaporation, 30 ml milk may get evaporated. So how can I expect you serve the 150 ml? But billing is based on 150. 150 ml milk's price will be charged for your coffee's milk. By adding the preparation cost and the coffee powder and other thing also the same happens. So billing is for 2660 unit and the cost is actually for 3000. The 3000 cost is recovered from selling only 2660. Now I am going to find out the cost incurred for purchasing this, but while billing I have to take this. Now purchase price. What is the price? 12,600, 19,000, 9,500. Okay. IGST, ITC not available. If ITC is available, no problem. If ITC is not available, what happens? You have to pay this. ITC available means you can get it refunded, otherwise it's final cost. You have to add IGST. No ITC. In case of ITC, you no need to add. Now you have to add. What is the value? Come on, total this. 41,100. For 41,100, 2055 is the IGST. Then what is the percentage they may have paid here? Probably 5%. So for each and every commodity, 5% may be the IGST. So you calculate the IGST for X. 5% on being 630, 950, 475. You have to add the IGST. Not only that, you have to add railway freight. Usually railway freight is charged based on the quantity. Based on the quantity. Is that okay? So X, Y, Z, 3,000, 5,000, 2,000, overall kg being 10,000 kgs. Railway freight will be always charged based on not the value, based on the quantity you transported. 1,000 rupees you paid for 10,000 kg, otherwise 0.1 is the cost per kg. In case of chemical X, 3,000 kg into 1, 300 rupees. In case of Y, 5,000 into 0.1, 500, and last 200. Right. Now, octroi is also paid. Octroi. Add octroi. Octroi is payable where? Only at Ahmedabad on receipt of the goods. While receiving the goods, no. Is that okay? What happened? While receiving the goods, this is a shortage. This is a shortage. Is that okay? While receiving the goods, 200 units shortage is there. This is the amount, number of units delivered. So you have to pay the octroi only based on the number of units you delivered. Octroi is nothing but city entry tax. Now we don't have. Earlier we had the toll tax. Now everything is calculated as a single cost along with the GST itself. So earlier we had this cost, the toll charges is payable based on the number of quantities delivered. Here you just see the number of quantities delivered will be only after the shortage 2800. For every item you delivered at Ahmedabad, you have to pay 10 paise. Okay, then 2800 into 10 paise, 280, and 472, 19, 190. And cartage also paid. Add cartage. Cartage. Okay. How much is that? 22. And I make it 63 and 32. Rounding off. Okay. In the text, I just gave the rounded value only, right? Okay. Hope now you'll be able to understand. Now, what is the total cost for X? The total cost for X being 13,832, Y 20,985, Z 10,397. Now find out the cost per unit. Cost per unit is nothing but this will be divided by quantity available. This one is the quantity available. You always means divide the overall cost based on the actual quantity available for the production. Rest of the quantity may be lost normally. The quantity lost is due to the preparation only. No, I recover that also from the customer only. So the price is going to be inflated due to the normal loss. So 2660 is the denominator value for X. 13832 is the numerator value. Then final value here be 5 rupees 20. Here 4 rupees 68. Here 5 rupees 76. Hope now you'll be able to understand this one. Let's now move on to the next illustration. Now, Question number 2. This question was asked in CMA Inter exam carrying 8 marks. Now, yeah. The manufacture of each unit of product X requires 2 kgs of raw material A, B and C. Kgs required, 2 kgs. And what about the price per kg? Then you'll be able to find out the total. Add up that. This is what about the material cost for product X. These 3 are raw material and product X is the finished goods. To find out the cost per unit of raw material, we have followed the earlier illustration. That's okay. For product X, only you have to find out the cost per unit. Thereafter, you can add up those things to find out the finished goods cost here. There was no opening stock of any material. The following transaction took place in the production period relating to the purchase of raw material. A's supplier charges 10,000 for 100 kgs of A. Okay. Right. Now, price, invoice price for A. 100 kgs, value being 10,000. Additionally, insurance was 600 and freight to get A to the store being 800. That should also be forming part of the cost. No, so you have to add insurance and add freight. Insurance being 600, freight being 800. And B's invoice price showed 12,000 charged by the supplier 100 kgs of freight for rupees 800, which was included in the 2,000. In case of B, price with the freight for 100 kgs, the value being 12,000. This 12,000 itself includes this 800 rupees also. There was no insurance. B had a normal evaporation loss of 10% in transit. If there is any normal loss, what do you have to do? You have to subtract the quantity only, normal loss. How much? 10. 100 quantity, 100 kg we purchased at a cost of rupees 12,000. While processing, before it gets delivered itself, we lost 10. So we now paid around 12,000 rupees for the 90 kgs of delivery. So from the customer, I have to charge 12,000 divided by 90 per unit, not 12,000 divided by 100. Okay, this is not logically correct. Okay. Then in case of C, C supplier charged 15,000 for 120 kgs price. 120 kgs, 15,000 kg and rupees. C absorbs moisture on the exposure to the outside air. By the time it came to the store, it weighed 120 kg. This is the normal feature. See, usually think there will be normal loss, but here we have the normal gain. Okay, due to the weight, that it's a moisture absorption, the weight is increasing. Understand? So you might have seen, how many of you noticed this? I don't know. While purchasing the soap, okay, body wash and body soap, 100 grams when packed. That's how a small term is used after the 100 grams. Go on note, because While packing, it may have more moisturized form, so the weight is heavier. Due to the storage, the moisture may lose. Then the weight may gradually decrease. So you should not raise any legal complaint on them. So it's clearly stated 100 grams when packed. Okay. It's usually the value quantity may reduce, but here what happened? No, quantity value is increasing. Why? Because it's so normal nature being absorbing the moisture from the air. Because of that, the value may increase. So in that case, you have to add this normal gain 30. So you have to recover price from the consumers only based on 15,000 divided by 150, not 15,000 divided by 120. Okay. Okay. Metal were issued to the production as per the requirement. Compute the metal cost per unit of X corrected to 2 decimal places using generally accepted cost accounting principles for material cost and giving the breakup of each raw materials. Very simple. Now we'll finish up this. So here 15,000 for 150 means per unit being 100 rupees. Am I right? I'll feed that here. So 200 rupees. Now 190 kgs only we have costing rupees 12,000 rupees. Then what about the per unit value? 133.33 per unit. Or 133. 267. The last case 100, the value being 11,400, otherwise 114. 228. What is the total cost? 695. Hope you will be now able to understand the finished goods value also. Now let's move on to the next one. You have to understand the terms spoilage, defective, scrap, and waste. We have the theory in the very front. So waste is nothing but that waste and scrap both are loss of raw material. Spoilage and defective are the loss of finished goods. First. And this waste is due to the manufacturing process you will be getting. Okay, during manufacturing process. Scrap is the residue of manufacturing process. Residue, okay. Clear. C. Wastage is loss of raw material. This loss happens due to the evaporation and shrinkage during the manufacturing process. During the manufacturing process. In case of shrinkage, evaporation, usually it is invisible. Sometimes it may have the visibility also, but Usually it has no recovery value. Hope you'll be now able to understand the waste. Okay. So you purchase the steel for manufacturing the door in your home, kept outside in the rainy season for almost 3 to 4 months, unused, got rust. After the rust, it seems to be non-usable and almost malleable, can be damaged only. You cannot even sell it for the meager scrap value. Then it's called waste. Okay. While manufacturing, some part may not be suitable. Its quality is substandard, so you are not able to use it, and broken, also waste. Is that okay? In case of oil, it gets evaporated, you cannot see. In case of something other than that, like this steel and the other component, may lose its value, but you can see, but it has no recoverable value. That is called wastage. In case of scrap, this is a residue. If you are manufacturing the table using the steel, after the manufacturing the table, you may have the steel residue here or there. For a second sale, like you can sell the steel for a nominal rate, it will fetch some income. In case of gold, after making the jewelry, there may be gold dust available. So all the goldsmith collecting the dust and the processing to retrieve the gold available in that scrap. Non-recoverable, then it's waste. Recoverable is scrap. Both are called raw material only. Scrap. Incidental residue arising from the manufacturing operation, small in quantity, low in value. Recoverable without further, we don't process it further, we sell as it is for a small amount. That's called scrap. Hope you'll be now able to understand the differences. Now, what will you do, sir? Waste happened. How can I recover this amount, sir? Is it from my pocket money or from a customer's money? From customer's money, I bill and collect it from the customers. If you are making any jewelry, the seller will demand to pay for making charges. Wastage and making charges, they demand. For wastage, 3%, sir. For making, 7%, sir. That's what they demand. So wastage is transferred to the customers. Now the question is whether the wastage is going to be recovered from the customer or burned by the owner. Now the question is whether the waste is due to his own carelessness or normal process of the business. It's a normal process, sir. If you want to manufacture any jewel, definitely there will be gold wastage. Collect from the customer. But while doing it carelessly, you overburned and it may be lost for some other reason. It's your fault. In that case, it is called abnormal waste will be charged to your P&L account. Your P&L account means costing P&L. Hope you'll be now able to understand. Now, this waste may be normal or abnormal. How do we decide it is normal waste? For every 100 grams of input, usually you will get around 95 grams your output value. 5 grams is usually lost. This is called normal loss. For the past 3 to 4 years, I observed and find out that this is the thing happening. But in this year, for the 100 grams, I got only 92 units. 8 units or 8 grams lost. What is my previous year's experience loss? Only 5 grams. Beyond that, I lost another 3 grams. You know, this is called abnormal. This is called normal. How can we determine whether the waste is normal or abnormal? Based on the past experience, technical factor, you can decide the waste being normal. Okay. Abnormal waste is normal yield less actual yield. Normal yield is 95. Normal yield is 95, but actually is only 92. Then 3 units lost due to some other reason other than the usual means inherent nature of the product. Then in case of normal waste, it can be recovered from the customer, add to the cost of the output. In case of abnormal, no, you cannot recover it from means customer's account. You have to pay it yourself from your pocket. What goes to your pocket because of the operation? Net profit. Charged to the net profit account, so automatically net profit will be decreasing, which is nothing but ultimately your money is going to be decreasing. So costing P&L account should be debited to costing P&L account. Clear? Now, in case of scrap, the value may be negligible or considerable. What will you do? In case of the sale value of scrap is considerable, good amount is there. What can you do? can be adjusted in the cost of production. What do you do in case of cost sheet preparation? Any scrap realized in manufacturing process is subtracted from the manufacturing overhead, right? So any considerable amount will be absorbed to the cost of output and job. That cost will be adjusted there. If the value is negligible, simply you can transfer to the P&L account. You can transfer to the P&L account. Clear that revenue, small revenue. Factory overhead may be 1 lakh rupees. Amount recovered by selling the scrap being only 10 rupees. Only 10 rupees. Don't write this as 99,990 rupees factory overhead after subtracting. This can be directly transferred to the P&L. Okay. So the difference between waste and scrap being value. Waste has no value. Scrap, of course, has the value very, very low. And what about the visibility, sir? Definitely scrap should have the visibility because it has small recoverable value. But in case of waste, it may have the recoverable value, means visible or non-visible. Both will form. Clear? Hope now you'll be able to understand the difference between waste and scrap. Now let's go for the spoilage and defective. Spoilage and defective. Okay. So defective is nothing but the output is substandard, not meeting my standard. It's called defective. So if the standard, the output is not matching the standard, what can we do? We can do some additional material introduced and labor cost incurred to make it perfect. Then it's called defective. Spoilage also lost, but by adding any additional material or labor you cannot rectify. Non-rectifiable is called spoilage, rectifiable is called defective. If you prepare the tea, sugar seems to be very less or very high, what will you do? In case of sugar is very high, add some more extra milk, right? Yes or no? Yes or no? Then okay, it becomes again tea. But instead of putting sugar, you dropped salt. What happens then? Spoilage. That's called spoilage. Sir, I will taste that with the salt. Huh? If it is salt, then whatever the amount I can recover with that salt tea, I can recover. Usually nothing. You have to throw it off. If you are having any possibilities of recovery, then you can recover. That's called spoilage. Hope you will be now able to understand the difference between spoilage and defective. Spoilage. Goods damaged beyond rectification. So, sold without further processing. If there is any chance to sell as it is, you can sell. Salvage value. Any amount recoverable from selling the spoilaged goods will be called salvage value. Accounting. Okay. Loss less salvage value. You prepare tea with the salt. Usually the tea cost being 10 rupees. Tea with the salt. There is no buyer. Anyhow, we will assume some buyer is there for 1 rupee. So the 9 rupees is the loss due to the spoilage can be debited to the P&L account, provided if it is abnormal reason. Clear? So in case of spoilage, any small recoverable amount can be recovered. Okay, accounting treatment. The loss less the salvage value. The loss is nothing but the entity has lost, and amount recovered by selling this being 1 rupee, 9 rupees will be your loss. If it is being the normal, then it can be addable with the good goods and recover it from customer. In case of abnormal, transfer to P&L. Transfer to P&L. Clear? Now, defective. Now, goods not meeting standard can be rectified by application of additional labor or other services. In this case, 100 rupees is the product cost. Okay, what happens? It is not as per my expected. So otherwise tea cost being 10. Suddenly we lost to add milk or sugar is high. The immediately customer demands for extra milk. So for extra milk maybe 1 rupee. By adding the extra milk, now tea is okay, perfect. Now tell me, will you recover 11 rupees from the customer? He will say, it's your mistake, how can I pay? No other way. So this extra milk cost will be adjusted by owner himself if it is being the abnormal reason. Right. This additional cost, rectification cost, named as rectification cost. Normally, sometimes it may be happening unavoidably, then it's called normal. No, sir, rare, sir, it's just because of my careless mistakes, sir. Then it's called non-inherent. It's part and parcel, sir. If I prepare 100 teas, 1 or 2 tea may go like this only, no way, sir. 2 teas, okay, tolerable. If it is beyond 2 teas, then it's intolerable. Okay, that's how it is identifiable, inherent or non-inherent. In case of inherent, it can be charged to the product. In case of non-inherent, it will be transferred to the P&L account beyond the control. And while recovering it from customer, how can you recover? If this cost is for a good units or specific job, responsible department, if you are able to identify with the what, sir, if you are able to identify with one of these 4 items, means you have to debit to there, means you have to add there itself. You have to add there. Okay. So I told you T and 1 rupee. Now, how do you adjust this 1 rupee? Is it going to be added to this cost? No. Will it be addable to the general overhead? So logically, where you can add, you can go and add. If it is identifiable with the goods, it can be charged to the other products, specific job, and you can charge to the jobs. Any responsible department, it may be part of department overhead, and otherwise it can be transferred to the general overhead. Hope you'll be now able to understand this one. So, for CMA students, this valuation of material receipt is given under Cost Accounting Standards number 6. This CAS number 6 is not required for CA students, but it may be asked in the CMA students also, right? Because this CAS is developed by CMA Institute only, so they are in need of these things to be incorporated in your examination. You have the overview of this, at least 4 marks you'll be getting. What CAS 4 says and 5 says, like, and small 2 or 3 points you need to remember in your examination, right? So material cost and trade quantity discount excludable. So the format I have given, you can have a small view about that. So already we have studied, no? So it's very simple. And just in time, also one more theory prepared by Toyota in Japan, actually launched by them. See, what do? You have EOQ, material levels and all, and stringent control of administrating the inventory, and team will be operating, isn't it? Storekeeper and the production purchase department, all. It has a cost to run that, right? Now, whenever you need, tell to the supplier, immediately he will supply the next moment. Okay, next moment he will supply. Just like the production department gives the requisition slips to the store department and gets the material, no. The same way the production department directly gives the requisition slip to whom? To the supplier, and gets the goods delivered. This facility supplier will give. So because of this reason, see here, Department A or Organization A, Production Planning Department, and they have the stores here, and B, their Production Planning Department, they have stores here, storeroom, and C, their Production Planning Department, storeroom here. D, you understand? For an illustrative purpose, storeroom, Production Planning Department, D. Here A should maintain EOQ as well as level. Similarly, B also maintain their own EOQ level, and all the departments, all the 4 organizations will be maintaining that. Now, supplier comes here with an idea, sir. Tell me, sir, what is the cost for running your stores department, sir? It cost us me around 50,000 rupees, sir, 1 lakh rupees, sir. For him, 1 lakh. For him, 1 lakh. For him, 1 lakh. Then what happens, supplier now says, Forget about administrating the stores department. I will keep a common warehouse for all the four departments, four organizations put together. Score out them. Production planning department can directly send me the requisition slip. I will supply the material here, collect the money from you later. So interesting, right? So by doing this, this 1 lakh will be totally removed. All the four organizations are now saving 1 lakh rupees. But supplier has to establish a warehouse common place for all the four, right? For them now they have to spend around 1 lakh rupees. This 1 lakh anyhow they have to recover, no. So yes, this common supplier says, I will recover around 50,000 rupees for this facility from you. Interesting, right? So every organization having their own stores control department, they have to spend 1 lakh rupees. Now this burden is transferred to the supplier for a fee of rupees 50,000. 1 lakh is now reduced to 50, so they save 50,000 rupees. Similarly, A, B, C, D, all the four are saving that 50,000 rupees. What happens in case of supplier? To have the facilities, he spends 1 lakh rupees, but he collects 50 from 4, then 1.5 lakhs is 2 lakhs is their gain. From the 2 lakhs, 1 lakhs is subtracted, 1 lakh ultimate gain is there. Clear? Hope you'll be now able to understand. Purchase right material, right quantity, right time, right place. Not excess quantity. If you want only 15 units, go and get that only. When? Now. Now means now only go. Go. Don't buy ahead and keep it in your storeroom. Right time. Where? Exactly here. So advantages of just in time purchases. Good supplier relationship for delivery of goods. There will be supplier relationship. Reduces the investment. We don't keep the material, so we never bother about the investments in inventory. Minimizes storage cost and obsolescence loss. If I keep it for 2 to 3 years, the stock may be lost, obsolescence loss. Now I don't keep this. This is now kept by the supplier on behalf of me. I never bother about that. So this is what about the theory of just in time. So all the theory of material costing is also over. So always remember, in material costing, EOQ material level calculation is very simple. Those things only you usually study for material costing. But in your examination, the background knowledge of this particular theory is very, very important to break some illustrations. See here. This illustration. Question number 1 for spoilage, defective, scrap and waste, one of the interesting illustrations. Right. $200 kgs of certain material valued rupees 50 per kg were issued from stores department to the production department. During transit, 2 kg physically disappeared due to shrinkage. So, material issue. How many kgs? 200 kg. Where 2 kg physically disappeared due to shrinkage. Now only 198 is delivered. Come on, tell me. Shrinkage is part of what? In case loss of raw material, it may be only due to 2 reasons. One is waste, another one is scrap. Scrap will be the residue of the process, manufacturing process, comes only after the process. But in case of waste, during the process, then it is what? Waste. Explain with reasons the quantities that you will classify as waste, scrap and spoilage. So this is waste. And 1% shrinkage is considered normal. Out of 200, 1% 2. This is only 2, then it is called normal. This may also be possible being normal or abnormal. Here it is normal. In the production process, the yield of good output was only 80% of the input. So, in that input, how much output you are getting? Only 80% output. Come on, tell me. 80% on this. 158.4. What about the remaining value? Hmm? 39.6. Okay. And 8% of the input had slightly substandard dimension, and this can be sold as seconds in the market at a discount of 25% plus normal selling price. Normal selling price being 300, selling price of the defective item being 25% less, 225. Am I right? This is what about the sale price. In this, see, this is 80%. Then this will be 20%. In this 20%, 8% is substandard item. Saleable at rupees 225. Saleable at 225. Okay, 12% of the input emerged as trimming in the process. 12% will be residue. Okay, trimming process. That can be sold in the market net price of rupees 20. It can be saleable at rupees 20. Okay, which is credited to the manufacturing overhead. It is adjusted in the factory overhead rate. Substandard means what? Substandard means defective. Residue means scrap. Okay, but the substandard is saleable or not? No, it is not going to be saleable. If it is not saleable, means it cannot be rectifiable. Rectification information is silent, then it is spoilage. As 20% being this one and 8% should be, come on, 39.6 into 8 by 20. Come on, tell me. 15.84 units. This is spoilage. In case of scrap, 39.6 into 12 by 20. What is the scrap number? 23.76. What will be the material cost per unit of the good output? Good output. So, we spend how much? $200 kgs at rupees 50 each. How many good units we got? 158.4. This is what about the output per unit. Clear? Cost per unit of output. If it is clear, text me. We'll move on to the next illustration. Make it faster, online students. See, all the questions I have added here, this question, this question, this question, all these questions were asked in the exams. But what we usually do, EOQ. Whenever we talk about material costing, immediately the sum comes to your mind is EOQ. No, it's not EOQ matters. It comes under other things also. See here. This question is one of the interesting advanced level question in your examination. Question number 1, question number 2, both. I may solve question number 1 and 2 here. Third sum may be applicable, I think, only for the CA now and then, rarely. I request you to go and watch the video for this. So we'll finish up 1 and 2 in this class. Okay, with that, material costing will be completely over. Yeah, come on. Join with me to solve this illustration. Actually, this question is a shocking question for the students when they face very first time this question in their examination. Why? Raw material AXC costing 150 per kg, BXC costing 90 per kg are mixed in equal proportion. AXC, BXC, both are mixed equal proportion. Okay, 50-50, 50% AXC, 50% BXC. Right. Maybe 100 is the input. Making product A, then you'll get output A. The loss of material in processing works out to 25% of the out product. So minus normal loss. 25% is on the output. If the output being 100, normal loss is 25 and if this is being 100, this is 25 and it should be how much? 125. On the output, 25% is lost. So if the input is 125, 25 may be lost and 100 will be the output. Otherwise, this 100 is equal to 125 means 25 should be 20, output should be 80. Is that clear? So the 25% of the product means output. If the A being 100, normal loss should be 25. Then input should be, before normal loss should be 125. After the loss, it may be 100. The production expenses are allocated at 40% of the direct material cost. The end product is priced with a margin of 20% over the total cost. Right. Clear? Now, what about the cost you get? This one being 150 rupees. This one being 90 rupees. 90 rupees. Okay, we assume we are supposed to manufacture 1 unit output. Okay. For 1 unit of output, what could be the mix? 1 unit of output. For 80% of the output, 20% will be the normal loss. For 1 output, should be 0.25. 1.25 should be the input. Out of 1.25, 50% AXC, otherwise 0.625. 0.625. You multiply these two, then you will get the total rupees. 0.625 into 150, 93.75 is the cost you spend for AXC. 56.25 cost to spend for BXC. Then overall material cost for producing 1 unit of output being 150. And the production expenses are allocated 40% of the direct material cost. So with that, you have to add production cost. Production cost being 40% on this. How much is that? 90. Apart from that, the end product is priced with a margin of 20% over the total cost. What is the total cost here? 240. Add profit. Profit will be 20% over the total cost. If the total cost here being 100, profit 20, and your sales price being 120. If 100 is equal to 240, means 20 should be how much? Is it 210, right? 40% 60, right? This one, sorry. 40% is on the material cost being 60. Total production cost being 210. On that, profit should be 20%, 42. Sale price is 252. This is the current scenario. Assume roughly. Now, the 3 lines. BXC is not easily available and substitute raw material CXC has been found for BXC costing 75. So we don't have the BXC, we have CXC. The price for the CXC being 75 rupees. From this it is very clear, BXC is costlier 90, CXC is cost lesser 75 only. BXC is 90, CXC is 70. Clear? That one is 90, this is 70. And customer will demand, sir, you have changed the price from 90 to 75, I am not satisfied, sir. Give me quality product. You used substandard raw material. Rather than BXC, you have given me CXC. I don't accept this. It is required to keep the proportion of this substitute material in the mixture as low as possible. As BXC is substandard material, rather than mixing 50%, earlier BXC and BXC mixed at the rate of 50-50. Now, as BXC is not available, they go for CXC being the substandard material, but substandard material component to be included lower level, as low as possible. At the same time, maintaining the selling price of the end product at existing level and ensure the same quantum of profit at the present level. So now what happens, by reducing CXC's composition, your cost may be reduced, but you are increasing the AXC's cost, so cost is increasing. Ultimate, your sale price, your profit, cost of production should be the same. Such a way, you need to find out what is the change in the mixture. What is the change in the mixture? Right. I need to get 1 unit here. 0.25 will be the normal loss. 1.25 will be the input, and I don't know the input to be calculated here, units. And what about the rupees in total? Total rupees should be the same 252. Your profit in the revised case also same 42. And your cost of production should be 210. Production cost should be 60. Your material cost should be 150 only. Your material cost should be 150 only. Is that clear? Now what happens here? This is also 150, isn't it? I assume X quantity of AX is used, okay, and Y quantity of CX is used. I am converting this into the simultaneous equation here. Listen carefully. Especially in costing, most of the illustration comes as a simultaneous equation format. One of such illustrations is this one. The same type we can use many of the different illustrations, even job costing, even some other chapters also you use the simultaneous equation. So you have to try to understand. X unit of AXE and Y unit of CXE is introduced at the maximum input quantity being 1.25 kgs. The cost being X being 150, so 150X. Y being 75, so 75Y. 75Y. So now you have to find out the X and Y using the simultaneous equation. See, X plus Y is equal to 1.25. X plus Y. 150X, I just take this one, unit column. From the rupee column, 150X plus 75Y is equal to 150. I multiply this with 150, 150X, 150Y. Yes, come on. 187.5. I cancel these two. Then I'll get 75Y is equal to 37.5. Otherwise, Y is equal to 37.5 divided by 75 is equal to 0.5. So here Y being 0.5. X and Y should be 1.25. Here this is 0.5 means this should be 0.75. So earlier 50-50. 625 grams AXE, 625 grams BXE introduced. But here 750 grams AXE and only 500 grams CXE. The CXE being the substandard raw material. So I reduced the composition of the CXE in our finished goods so that the customer will be happy. My ultimate aim, making 42 rupees profit and selling price remains the same to 452 should be not altered. Make a note of it. This question number 2 is one of the interesting illustrations asked in exams, CA exams. C. Again the UOQ calculation, but missing data like you have to solve this illustration. A Limited was ordering economic order quantities EOQ, its raw material RM at a price of rupees 750 per unit. Price being 750. Average annual consumption was 18,000. Carrying cost was 20% of average inventory. Ordering cost 1,500 per order. A Limited wants to move towards just-in-time system. The new policy proposes as follows. The average number of units held in stock will be 100 units. In case of JET, average stock will be only 100 units. Ordering cost per order will be 1,510. And carrying cost will be 20% of the average inventory. On the average inventory. However, the purchase price will increase. Purchase price will be increasing. This will increase under just-in-time approach. The total new ordering cost will be 9 times the new carrying cost. Okay. So the ordering cost in just-in-time approach is equal to 9 times of the ordering cost of the present time. Okay, 9 times the new carrying cost, the total new ordering cost. Okay, the new ordering cost will be equal to 9 times of carrying cost under JAT model. Now, what was the EOQ before the new policy? If you multiply these two, you'll get carrying cost in unit 150. Find out the EOQ. EOQ is equal to root of 2AO by C, 2 into annual consumption 18,000, ordering cost 1500, carrying cost 150. Take the root of this. 600 units. Okay, 600 units. You'll get 600 now. Is it clear? Calculate the inventory turnover ratio before and after the new policy. So we can calculate the inventory turnover ratio now. How do you calculate the inventory turnover ratio? Okay. What is the formula for ITR? ITR is equal to inventory turnover ratio raw material consumption by average stock. Raw material consumption or cost of goods sold, you can take any one of them, or sales. Now the raw material consumption being 18,000 existing, what is the average stock now you have? You order 600 units every time, means average should be half of that, 300. 60 times. In case of JAT, just-in-time approach, the average inventory in this case is equal to 100 units given here. Then the value being 180 times. 180 times. Is that clear? We got this now. Clear? Second question also answered. How much is the increase in purchase price under the new policy? How much is the increase in purchase price? See, purchase price is increased due to the JAT approach. because supplier demands some extra compensation, right? Now we have to find out what is the extra value. For that, this is the clue. Ordering cost is equivalent to 9 times of the carrying cost. Come on, tell me. What is the ordering cost? Ordering cost is equal to annual requirement divided by quantity per order multiplied by ordering cost should be equivalent to carrying cost. What is that carrying cost? Carrying cost is half of quantity ordered every time multiplied by price into carrying cost percentage per unit per annum. Is that okay? But here, as per the JIT approach, 9 times of this will be this one. Ordering cost is equal to 9 times of the carrying cost. We framed the equation like, now you have to solve this. The annual requirement in this case being 18,000. Quantity ordered every time being, what is the quantity you order every time here? Average 100 means quantity order should be 200. 200. Average stock is equivalent to this much. Actually, average is equivalent to quantity by 2. Okay, now average is 100 means quantity can be calculated like this: 100 into 2, 200. 18,000 into 200 into ordering cost is how much? What is the ordering cost here? 1,500. JIT approach is 1,510. Okay. Should be equivalent to 9 times of 0.5 into quantity ordered every time being 200. I don't know the price. I don't know the price. I supposed to calculate the price only. Carrying cost per unit per annum being 20%, 0.2. Now finish up this side, left hand side value. Finish up the left hand side value. One lakh 1,35,900. Finish off right hand side value. 0.5 into 200, 100. 100 into 0.2, 20. 20 into 9, 180p. 180p. Then P should be equivalent to 1,35,900 divided by 800. 755. Earlier the price is 750. Now the price increases to 755. Increase in price being 5 rupees. One of the interesting illustrations. Clear? Okay.